You're watching a special edition of Business World Live. I'm Danie, Laurel.
And I'm just Delos Santos. The COVID-19 pandemic has changed the way Filipinos consume goods and engage in services as it puts a plug on economic activity. The result of which is steady inflation settling within government target. Now the downside, though, worse than expected consumption levels. Inflation picked up in January this year following typhoon damage to crops and the Taal volcano eruption. The figure began to dip soon after, mostly driven by the onset of the pandemic. During the first months of the health crisis with lockdowns in place, inflation settled in the low end of government's 2 to 4% target before picking up in July due to increase in transport costs. Households resorted to limiting their purchases to essential items in order to preserve cash as work and businesses were affected by quarantine measures. In November, inflation accelerated about 3% due to massive agricultural damage from back-to-back typhoons. Combined damage from typhoons Quinta, Rolly, and Ulysses had been estimated at 12 billion pesos. The three most affected regions were Cagayan, Calabarzon, and Bicol. And even as the government moved to ease restrictions later on in the year, household spending wasn't quick to catch up. Metro Manila has since been downgraded to the second least restrictive category, GCQ, in order to drum up consumer confidence. Progress over COVID-19 vaccines also came in the last few months of 2020, sparking optimism and later on a market rally. However, this wasn't enough to push consumption. Market analysts and economists were in sync in commenting how the central bank did most of the heavy lifting this year, firing monetary stimulus after another. As for the fiscal side, the general sentiment was that it seemed lacking. The Bangko Sentral ng Pilipinas slashed key rates by a total of 200 basis points this year in hopes of cushioning the economy, which plunged to a technical recession in the second quarter. The cumulative reductions had offset the series of rate hikes the central bank implemented in 2018 to ease inflation. Benchmark interest rate is now at 2%, while overnight deposit stands at 1.5%. Lending facility, meanwhile, was reduced to 2.5%, all during a surprise cut in November. The BSP then kept rates steady during their last policy meeting this month, but this is seen as a temporary pause. Analysts expect the central bank to maintain a dovish stance in 2021 to support recovery and to utilize untapped liquidity. Banks continue to be challenged in the third quarter with asset growth slowing and a decline in issued loans. Bad loans grew 35% quarter on quarter to 287 billion pesos and was up 80% compared to the figure in the same period in 2019. But the government is hoping to turn things around next year. The BSP revised its inflation expectations upward this year and in 2021 while keeping its 2022 outlook unchanged. The projections still fall within the 2 to 4% target band. This comes alongside government's push for a rebound of 6.5 to 7.5% in 2021. The central bank is expected to continue its accommodative easing next year, dragging real interest rate further to negative territory.
$7,139.71. That's down 8.64% year to date. This is the hard-won level of the Philippine Stock Exchange Index, wherein we ended trading with in 2020. Will things be kinder to us in 2021? Here to give us his year-end views, we have with us Jonathan Ravelas, of course, the Chief Strategist of BDO. Hello, sir, and thank you for joining us today.
Good morning, Danie.
Sir, let's kick off with the market close. I mean, down, but at least we are down, if I could say so, single digits compared to the major drop we saw in the height of this lockdown, which was more than 40% of a drop. Are you satisfied? Are you proud of how resilient at least the equity markets were in the face of all these challenges?
Oh, yes, definitely. I guess coming from a point where we were down 24%, and it took a while before the optimism came back. I guess people weren't convinced of how we managed the pandemic. So it took after at least 2 quarters before we got to see the cases going down, and we started seeing the market moving back up from the 6,000 to the 7,000 levels.
Sir,
So
what were your yeah, go ahead, sir.
eventually, I guess we peaked at 7.3. I guess uh, by then we were at close to 20 times PE ratio. So basically, I guess that we're technically at full value in terms of the expected earnings this year. So I guess people now are just staying on the sidelines and waiting for some cues of what to expect in 2021.
Sir, can you give us an idea of which were your favorite sectors, which ones outperformed in terms of your expectations, and which ones do you feel are still going to be suffering or undervalued as we go into the new year?
Okay, I guess at the start of the year, most of the expectation was just the usual infrastructure, real estate, the retail sector. Eventually, now, because of the pandemic, there was a shift more for the telco and consumer staples. So they eventually performed well. Now, as we expect that we will further reopen the economy next year, and the government signaling a uh, infrastructure spending as well, further government spending, then definitely there could be a shift from the telco and consumers and eventually pivoting back to infrastructure stocks, construction, real estate, uh, and eventually back to retail as we reopen the economy.
Sir, let's talk about the way you see the equity markets moving and how you see the economy having fared in 2020. Did the economy prove to be, given the unemployment rate, given the GDP contractions that we've seen, inflation staying quite low, did you feel that the economy itself was resilient, or did it show cracks in the system that were present even prior to the pandemic?
Oh, well, I guess in terms of the economy, it took time. I guess the high unemployment and eventually the time to restart the economy took a while. Because I guess one of the things is that people weren't convinced on how we manage the cases. So we were very reactionary to test, trace, and treat. That was the government strategy. Until such time we started, as of the third quarter, being more proactive in doing the necessary um, precautionary measures, such as telling everybody to wear a face mask, face shield, and social distance. So right now we continue to do that so that we'll further reopen the economy. I guess the difference between the stock market and the economy is that those in the stock market know that uh, once the economy is able to adjust to this pandemic, uh, you know, it's gonna be business as usual. For some companies, they manage to live with the virus. So that's why you've seen the stock market from 4,000, and it went to as high as 7.3, and we're now close to 7.1. Now, but in terms of the economy, I guess the key difference is that the resilience is there. It's just that it's not recorded. You just have to look at your phones, uh, Viber, WhatsApp. There's a lot of trading going on between goods and other services. It's just that they don't pay taxes or sort of pay taxes. So
Sir,
it's not as well recorded.
You mentioned consumption is key here, but without further fiscal stimulus, which we had mentioned in the banner kanina, a lot of analysts have said is lacking compared to the weight that the BSP has pulled in terms of liquidity here, and even compared to all the other countries. Now, even the US has a new package. How will consumption be driven without additional stimulus, given the fact that also Sec Dominguez has mentioned fiscal discipline will continue?
Well, basically, I guess you need to understand that we are in a situation that we are in the same storm but different boat. Whether you're the US, Singapore, they have a lot of money to spend. One of the things that's good for the Philippines is that we've seen the central bank doing the W strategy, whatever it takes to be able to help the economy. So they've done things that previous central banks governors haven't done to be able to help the government and eventually remain accommodative in terms of policies. The second is that we've seen the government in the 2021 budget preparing for an infra spending. Hopefully, this will uh, give consumers and the business sector the confidence to do a follow through. So when things are again, it's really more of a confidence building. So we're expecting that come 2021, when the government starts its infrastructure spending, the businesses will follow. That's why the key here is, of course, being able to see the further reopening of the economy. I guess we just heard the president talk about extending GCQ till January 31, 2021.
Sir, will monetary policy or easing be useless, so to speak, if this doesn't happen? Because they've been very preemptive, but as it stands, the loan growth has not necessarily shown that the consumption trend is there. And a lot have said that, we need, as you mentioned, the confidence to be coming back. We need the economy to be reopening before any of these, policies can even benefit us.
Well, basically, I guess the key here is confidence. You see, you can. I think what you're trying to say is yes. If you look at where the accommodative policy, we're already at historic lows. Policy rates are between 175 to probably, and it could still ease moving forward. If you follow the central bank, no? But again, this is a situation where you can say that you can lead the horse to the water but you can't force it to drink. The rates are already low, so we've seen some companies taking advantage of that liquidity and the low rates. We've seen a very buoyant debt market. So from a dollar perspective, we've seen around close to $8 billion of corporate borrowings on the international market at historic low interest rates. Even on the domestic, we've seen some companies also tapping the debt markets for it. But these are the big corporates, but the rest, we'll have to see how the business environment will uh, take shape. And that will take, number one, the health pandemic. What would be the effective pandemic management that the government will do so that we're able to further reopen the economy? When that happens, then you'll see consumers being more confident because jobs will be created. So they're sure that their jobs will be there so that they can spend more. Businesses, when they see more mall traffic, uh, and eventually people really more confident of going out, then that's the time they'll probably tap getting loans. But in the meantime, this pandemic has eventually created a shift into the financial inclusion. And I think this is something that, again, could revolutionize business. Because right now, we are able to fast track digitalization at a faster rate than in the early 1980s. No? In the 1980s, when the other bank, BPI, introduced Express Teller in the Philippines, it until today, you can still see people having a passbook. But because of this pandemic, people started opening digital wallets so that they'll be able to survive. And businesses can do the same.
Sir, one last question po before we let you go. This pandemic has changed the ways in which we live, in which we work, the ways of doing business. But it does seem that the government is bent on continuing the plans that it had pre-pandemic. So you still have them, wanting us to recover via consumption, wanting us to recover via specific sectors like the BPO sector, remittances, which were historically strong, and with the infrastructure push. Do you feel that now is the time to be doing more structural changes in terms of which sectors we need to be supporting here, how we are going to have a recovery? You mentioned digitalization, so perhaps investing in skills, education. What's it gonna take for us to have a sustainable recovery after this is all over?
Okay, let me just digress a bit and talk about Duterte's 10-point agenda. Of course, I've narrowed it down to three things. It's build infrastructure, develop social capital, and opportunities to seize. And that opportunities to seize is basically agriculture, tourism, and manufacturing. So I'd like to focus on the manufacturing. With the passage of Create, we can now attract more foreign direct investors to the country. Those that are already here, whether they're in Batangas, they're in Clark or Subic, that are already existing, they can now expand their operations because now there's a clear-cut definition on the potential incentives that they will continue to receive. And to those that are new, can eventually bring in their investments in the Philippines after almost 3 years of waiting for the potential changes in uh, the tax incentives for foreign direct investment. So we need to do the infrastructure because we need to be able to compete. So this is very important that we're doing it already. So that will focus on the manufacturing side. In the last State of the Nation address of the President, uh, uh, Duterte continued to highlight the building of infrastructure. He eventually mentioned the digitalization of government and eventually offer online services. So again, the trust definitely from the whole government perspective is really a shift which is still embodies what they wanted, including the IT related. Now, when it comes to jobs, this is where the demographic dividend is good for the Philippines. Given the average age of Filipinos today is 24 and a half, we're able to retrain this workforce to address the needs of the digital age. So dexterity-wise, now that we're more confined to the computer to be connected, it's easier to translate uh, these types of skill to these Filipinos. And eventually, the BPO sector became one of the more resilient sectors in the sense that despite our connectivity issues, they were most of the call centers adopted a work from home. So
Okay.
that gave your steady increase of remittances. And of course, the OFW remittances. Early part of the year, people were expecting that, we'll have a 5% decline. Right now, we're practically either flat or we'll probably end the year at 1%. But eventually, half of those workforce that came home have been redeployed back. So it's just a question of how are we going to, those that will never go back, can they be retrained for construction? We have TESDA. They have a lot of programs that are ready for them. It's just a matter of coordination between the local government units and where they are so that the jobs are eventually going to be
Absorb.
distributed.
Okay,
So
thank you, sir. Go ahead.
I guess just to add, despite the delays in the infrastructure, there are a lot of the infrastructure that are in the local government units, which you guys don't talk about. No one bothers to go through the LGU and say, all right, what are you guys doing? But if you actually go through their website of Build, 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 you will see that there are over 1,800 projects. And for some of them, they're already ongoing and are on track. So which is good. So there's that opportunity for the jobs. Again, it's a matter of really number one, addressing the pandemic, and in the sense of it's really more of uh, telling everybody to have a very good pandemic management. So every time you
Mhm.
go out, you just have to follow all of the protocols so that you're confident every day going up and going out and normalizing your daily activities. And once you get the confidence, the businesses will pick up. So this is I think it's like bringing up a toddler. So we need to become confident in helping the child walk alone. So that's the same
Yes.
thing every day. And that I think is a bit different from talking about equities and the economy. Because this time it's really all about us being more confident of resuming our lives.
Thank you, sir, for those insights. And we really do hope that we go and tread on that path. And of course, banking on our demographics, which might be a very positive way for us to move forward in these difficult times. Thank you so much, Jonathan Ravelas, Chief Strategist of BDO. Thank you, sir.
You're welcome and Happy New Year.
Now let's head on over to news overseas. The United Kingdom has its hands full dealing with a new COVID-19 strain, as well as its official exit from the European Union. The UK and its post-Brexit transition period today. Bloomberg explains what happens next.
No matter what, the UK's relationship with the EU is changing. Europe's four freedoms of movement will no longer apply from 2021. For Brits travelling across the Channel, you'll need 6 months on your passport and only be able to stay for 90 out of 180 days. Want to live and work? Well, the withdrawal agreement protects the rights of those already abroad, but to move in the new year, there will be new costs and residency requirements. Goods trade will see more friction. There will be new customs declarations, special certificates to move food, animals, and plants, and you'll need the right paperwork to even get close to some UK ports. To avoid chaos, the UK is giving importers a 6-month grace period, but the EU is not following suit. There are changes for services and capital too, though a lot remains unclear. The City of London is set to lose its automatic right to sell into the EU. The UK has granted broad equivalence for EU capital, auditing and insurance, but Europe has been narrower, granting just temporary equivalence for UK clearing, and is in no hurry with other financial services.
Now, for a country where cash has been king for ages, the pandemic has quickly shifted the attitude towards digital payment as more Filipinos abandon cash. Now, to talk about the level of acceleration they had in 2020, we have Kenneth, Palacios, Director and Head of Wallet Partnerships over at Paymaya. Good morning, Kenneth. Great that you could join us this morning.
Good morning, Jess, and nice to be here. Thanks for having us.
All right, so a quick look back at what happened in 2020. How would you say has the landscape when it comes to digital transactions changed over the past 12 months here? Of course, it's been said time and again, that e-commerce has experienced a boom due to the pandemic. Would you say that the growth in digital transactions, digital wallets, is somehow parallel to the growth that was seen over in the e-commerce sector?
Oh, definitely. In fact, Paymaya was actually very fortunate in the way that we were capitalizing the market movements. And I would like to say that it's a phenomenal year for us, not just because of the number of transactions that we've had and the transaction volumes that we've experienced, but also phenomenal because we've helped a lot of people. Recently, we've mentioned that we've already breached over 28 million users within our platforms across all of the ecosystems that we use. We have been very fortunate to help a lot of enterprises, retail merchants, as well as micro businesses. No? And I think this is very important development in the way that Jonathan earlier was talking about
Mhm.
digitization. Now, Paymaya is working hand in hand with the BSP and many other government agencies to actually accelerate those programs. In fact, Paymaya was one of the FSPs who was included in the DSWD programs for the SAP disbursements. And recently, also over the holidays, we've been helping many other local government units dispense cash via the Paymaya wallet to senior citizens, to students, and to many other constituents because it is faster for them, it's safer for them, and most importantly, they get a lot of benefits because of the cashbacks that we're using and giving people because of the QRs that we are using in our merchant partners.
All right, good that you mentioned that. But the thing is, how would you say is our level of adoption here compared to our neighbors in Southeast Asia, especially when it comes to digital wallets here? Because if you try to take a look at domestically, there hasn't been rapid growth when it comes to digital payments, but that only accounts for a very low volume of the payments made at least per month in the country this year. What do you think needs to be done to somehow further accelerate the level of adoption that we have when it comes to digital payments?
That's a very good question, Jess. No, in fact, I don't want to discredit too much the work effort that all of these sectors are putting into digitization. Because for Paymaya, as an example, last year over this year, on our peak month of May, we've experienced over 1,000% growth on our services. And I think this is very much the same with many other businesses in the Philippines. If we compare ourselves with other Asian countries, there was a recent report that came from Economy Southeast Asia that was written by Google, Temasek, and Bain and Company, that they were saying that pre-COVID, there was about 48%, a decline from 48 to 37% of people using cash, and an increase in e-wallets from 18% to 25%. Definitely, we're seeing a lot of this, especially within Paymaya. And I think to accelerate and continue that momentum, we see government providing assistance and help. We see a lot of businesses adopting cashless. I was shopping over the holidays in some of our partner merchants in Rockwell, Mega World as well, in the malls, right? And you'll be surprised before when people were asking for card as a mode of payment. Now they're asking, why don't you pay via QR? Because it's safe, it's faster as well, and it provides you immediate an interaction in terms of the transaction that you did. So you know that it was actually completed. So these are just things that we are beginning to see that are now rolling down all the way to the grassroots. So an example, Paymaya today has over 100,000 business partners, no, ranging from micro businesses all the way up to large enterprises. And the way that we are seeing them use the products is diverse. From people sending out email, chat messages asking for payments for services that you've rendered, all the way to QR payments to the Sari Sari store. And I think this story of adoption uh, is not anymore something very hard to do. It's something that is people are already welcoming. As you know, there are a lot of people who are on Facebook Messenger, and because of this access, they are familiar with our services. In fact, I mentioned earlier our disbursements to senior citizens, right? So
Mhm.
normally people would think that serving senior citizens is quite difficult. It is true, but if you give them enough literature, enough education and training, they'll be able to adapt quite well. And in fact, they want it because it's faster and it's much more seamless. They don't have to queue in lines, but definitely just be able to receive the money and transact with whatever merchant that they want to.
Okay, given that, Kenneth, considering, of course, the rapid growth, there are still holdups. So we're talking about security. That's one of the major reasons in the past why Filipinos were slow to adapt when it comes to digital transactions. At the same time, connectivity still an issue here. But given that, looking forward, what's your outlook for 2021 and how are you seeing the landscape here when it comes to digital transaction? Do you see these holdups finally somehow being lessened or being answered in the coming year?
Well, using digital platforms is actually much more secure than having physical cash. And we are actually converting many of the industries today that have been collecting cash when they make their routes in their ecosystems, predominantly because they want to avoid this particular problem. One of the pain points that people realize when using digital platforms is that they are easily duped. So people ask for their passwords, ask for their one-time PIN. So one of the more important things is that personal security. People need to understand that they keep their passwords to themselves. Do not share any confidential information with anyone. None of the banks, central bank, or anyone, even the president, do not ask for your password. So please keep that safe because this is the biggest fraud that we have experienced. Other than that, it has been really, really safe. And in fact, Paymaya, as an innovator in this realm, is adding much more layers of security from artificial intelligence, from face mapping, and many other solutions to really just provide guarantees and assurances to people that when they put money into our e-wallet like Paymaya, it is much more safe. And finally, this is also premised upon the way that people are using our ecosystems. So, as a wallet owner, as a wallet user, as an individual, a person can make transactions to retail merchants. And not necessarily do they accept Paymaya, but we also empower them to accept all sorts of payments from credit card, from bank partners, as well as other e-wallets. So, as a retailer in that context, I don't have to worry about choosing a different type of technology for accepting a different type of payment, right? Having Paymaya alone will be sufficient because it allows them to accept all forms of payment. So this completes the security of the transaction, not just of the user, but also of the merchant itself, from large all the way down to the micro businesses.
Okay, thank you very much for your time this morning. Again, Kenneth Palacios, Director and Head of Wallet Partnerships over at Paymaya.
Thank you, Jeff,
Happy
and
New
happy
Year.
New Year.
And those are the biggest business news and insights this morning, December 31, 2020. I'm Jess Delos Santos.
Catch us again tomorrow. That's New Year's Day 2021. That's 9:30 a.m. I'm Danie Laurel. We are One News.